Hey guys, this is Simon with Trade and Perform Coaching, and wanted to go over the week I missed, and look forward to the week going forward, and just take 5 minutes and cover the key critical areas for ES for the week. So first thing, obviously, let's just kind of build this together of what we're looking at. This is the year-to-date high. This is the most recent swing low, and well, actually, this is the most recent swing low, and so we'll call this down here the we'll call this the grease low, and then this is last week's low. Let's see, that's Friday, Tuesday. Let's see if we can go through this. Friday, Thursday, Wednesday, Tuesday, Monday. This is last week's low. And then finally we have last week's high, which was also Friday's high. So let's change a few colors on here so we have a good landmark. And then what we want to look for in here is if there's, the first thing we want to go through and ask a couple of questions. So first, are there any open gaps that have not been taken care of by the market yet? And the obvious question to that, and I always start off with a volume profile, because volume profile basically gives me a lay of the land very quickly and is very easy to read. So, and what these bars are doing, if you're not familiar with volume profile, is they're simply taking a normal bar chart that puts volume down, you would normally see it at the bottom. It's taken price, and it's giving me volume by price instead of volume by time. So the only open gap of note that has not yet been filled is this one here, roughly 21.14 1/4. We'll color that red. Okay, and on the downside, it appears that there are no open gaps except all the way down to 21.41 1/4. I'll color that red. And okay, so what this has done has already given us really a pretty easy way to look at the market, right? First of all, in terms of being bearish or not being bearish, what are the couple of things that have to happen? What's the other critical pieces of information that are on this chart? So first of all, we know we have open gaps below and we have open gaps above. The other piece of critical information that is on here is that we are right now one timing to the upside. So what does one timing mean? And I need to do a complete video on this, but in the interest of being brief, let me see if I can grab my drawing tools really quick. There we are. We have Epic Pen coming right up. And while using Epic Pen, one timing, you can see on the way down, this is one timing to the downside. It simply meant when we were moving down that there was the market had no ability to trade above the prior day's high. And you see we went all the way down. And you can see, and this was quite violent, we reversed here. This was the date on which we were no longer one timing to the downside, and you can see that the market started to push to the upside, and we started the reverse. We started one timing to the, instead of one timing to the downside, we started one timing to the upside. This is important because when one timing ends, what that tells me is, first of all, to look for a clue or gives me a thought process to follow that the behavior pattern of the market has changed. Now, this is an example of where it changed relatively aggressively and radically. It doesn't always work that way. Sometimes that one timing can change to a sideways market, or the trend can continue. But what it prevents me from doing is, for example, instead of fighting the market to the long side all the way down, when I know that it's one timing to the upside, I can at least wait until we trade below the prior day's low before getting aggressive to the short side. Where did that pay off? I can show you. It was actually particularly helpful in this area here, right? I didn't get caught in the run up here because I knew that we were one timing, and you can see we finally trade below the prior day's low on this particular date, and then the character of the market changes. We're one timing to the downside here. You can see, now notice, once the market stopped down one timing to the downside, you can see the trend is broken, but look, the behavior changed. We went from a down market to basically a balance in a large area, but it was no longer trending down, and we switched to a two-sided market. You can see here we were one timing, 1, 2, 3, 4, 5. It was finally on this day right here, actually it was this day right here, that we stopped one timing to the upside, and you can see the pattern switched back to the downside. Why was this important? Because right now, if you look at the market, the most viscous area is everything between 2100 and 2060 is extremely viscous. What that means is I don't want to step in the way of the market in whichever direction it's running, and I'm looking for clues that that trend might be changing. So going into tomorrow, as of now, we're still one timing to the upside. I don't want to be overly aggressive. My first clue that sellers will take control is if we can trade below Friday's low. So that's the first piece of information. So I've gotten a couple of pieces of critical information off the mark. I know off the volume profile. I know where the year-to-date high is. I know where last week's swing low is. I know where the two open gaps are sitting. These make natural targets. The markets tend to like to close open gaps. I know that that buyers are in control and that we're one timing to the upside, right? I know that we're particularly viscous between really 2100 and 2060. And what that means is that the market tends to be just simply ripping one direction and then the other between those two areas, right? If you look, this particular bar, everything below what appears to be 2085, all the way down to about 2068, this particular area is very poorly auctioned. And when a market's very poorly auctioned, just like the market likes to close the open gaps, it likes to come in and re-auction areas that are poorly auctioned. But there's also another piece of important information in this poorly auctioned area, and that is when the market gets to a poorly auctioned area, it tends to bounce first time into that auctioned area. About halfway through, it tends to bounce back and comes back and tests the top of that range, and then it tends to come all the way down and complete the auction. And when it completes that auction, it tends to go back and continue on its merry way on whatever the prior trend was. So in this case, it would be back to the upside. Let's go through, and wow, my voice is not recovered from vacation yet. So there's another very important piece of information that's in here. So besides knowing that we need to trade for next week below Friday's low before we even start to consider whether sellers are gaining the upper hand, right? That would be the first clue. So a look for a gap down below and a hole below would be a clue. If we tend to trade below the prior day's low, usually odds are, unless this isn't done in what's called an open drive lower, odds are we will usually U-turn and hook back up and attempt to close above that prior day's low, which is fine. There's no rule. Again, as long as we're one timing to the upside, I don't want to be overly aggressive to the short side of the market. It just simply makes my life as a trader easier. Finally, what's reachable is the next thing that I want to look at when I'm approaching the market for the next day. And again, what I'm trying to do with all of this is I'm trying to lower any anxiety that I might have about trading and increase my confidence in my ability to take the trades. So I know that 2041.25 would be a very nice place to take a long trade. However, it's highly unlikely that we'll reach that area. As a matter of fact, the maximum meaning if we just had a terrible down day and we got a lot of energy and selling pressure to the downside, I would anticipate the maximum we'd be able to push down to is 2070. And oddly enough, at 2070, if you look on this day here, we have a low volume node here, and I would want to be a responsive buyer near that 2070. And I also know, because of the way the market trades, that anything below -20 tomorrow, that we are highly unlikely to close in that territory. So if we closed at 2098, I know that 2078 which would put me right here. There we go. So I'm going to mark this area off and highlight it. So I already know when I'm coming in to prepare for the day that between this 2078 and 2070 location, that first of all, I do not under any circumstances want to be looking for a short in this area. Not that a short can't work, but that the odds in this area are very much against me. Okay, so then I want to do just the opposite. On the upside, 30 points up from 2098.50 put me at 2128.50 right here. So a couple of things. First of all, that would put me at a new high for the year. And secondly, if we look at the characteristic of the market on the upside versus the downside, while the market has been able to push 30 down, it's really only been able to muster about 20 to 25 on the upside. So where that puts me in is 2118-ish, all right, to 2123, which would be about right here. That's really all the gas. I'm going to mark that off like this. So I would say, short of having a significant gap and an open drive higher, that the year-to-date high is just out of reach for tomorrow's range, and that this is probably going to be about as far, even with strong buying power, this is going to be about as far as the market's going to be able to push. And really everywhere from this 2114 and a quarter all the way up to this 2123, I want to be more focused on looking for short location than I do looking for long location. Important concept. I look to, when I'm approaching the market, and again, remember, I'm coming from a pure day trading perspective. I want to buy when people are dislocating to the downside, and I want to sell when dislocating to the upside. As long as we're one-timing to the upside, right? And really, if you look, and people look on these pushes down, this is the year-to-date high, right? If you think about it, think who controls the mechanics of the market. It's hedge funds, mutual funds, pension funds, and generally people who put money into their 401k. The majority of that money rolls into long-only strategies, and it runs into funds that have to be fully invested. Those people tend not to freak out unless the market is down significantly. That just simply takes time. So I know that on my short entries that I'm going to be, particularly given where the market is and the strength of the market, that I want to be quicker to cover my shorts, and I want to be more patient with my long side pushes. And if you looked all last week, that paid really big dividends all week long. Also, I want to make sure that I'm really stretched on the upside, at least conceptually for shorts, right? I do have an indicator that I follow that will sometimes give me short location that's less than ideal, but even no matter where I get my execution for the shorts, I want to make sure of a couple of things. First of all, I want to make sure that I have good rotation. That means that from whatever the swing low is, I've got at least 6 points to the upside when I'm looking to take a short, right? Same thing with the downside, but particularly with the upside, because I know the upside's working against me, I want to make sure that it's stretched. I want to limit the amount of time I'm willing to stay in a trade, both long or short. Generally speaking, for me, that's 15 to 20 minutes, right? And then what's the last piece that I want to go in? I want to make sure, since I know the primary characteristic of the S&P 500 is for it to trade in somewhat of a fashion like this and variances of this, right? I want to make sure that I'm not getting bearish when we're already down more than 20 points on the day, and I want to make sure that I'm not getting bullish when we're already up more than 15 points on the day. Following these simple reminders, taking a look at where the market's likely to reject on the upside and the downside, right, and where we're likely to get responsive buyers, this can already help your mindset. Even if you don't have specific areas where you want to trade, or your charting ability hasn't grown strong enough to know from which point you want to trade, always keeping in mind that you want to sell strength and you want to buy weakness if you're trading the S&P 500, right? Because the S&P 500 tends to be a non-trending entity intraday, right? You may look at the chart and it may look like this over a long period of time. But if you look at the majority of days kind of go like this. Even on the upside, or most of the days will end up looking like some variance of this. This past year has been an exception. We've ended up with a couple of trend days up, and trend days down. But usually, and when I say usually, I'm talking about over the last 5 to 10 years, the majority of days are balanced days. Majority of the day, the market's in a trading range, and that means for the S&P 500, you want to look to sell strength, you want to look to buy weakness, and you want to let the market panic on either end of the edges and try to trade the S&P back into the middle for the most part. So I hope that helped. I want to summarize really quickly, and then I'm going to let everyone go. I've already posted my specific trading zones for members of the room, but I want to give everybody a clear understanding of what we are looking at, where the key critical areas are. So obviously we have the year-to-date high. Probably, unless we have a significant gap tomorrow, we're out of reach of breaking that for tomorrow, right? Most likely. This open gap, this 21.14 should provide great trade location for actually for, I would think, a swing short back to the downside. On the long side, this 2078 to 2069 area should provide multiple long trading opportunities out of this area, right? For the week, critical that we hold above last week's low, right? It's really, there's no point in being bearish unless we trade below last week's low. That's a pretty high hurdle for the market to make for the week, right? We're not super bullish unless we can get above and hold above 21.28 and the first major hurdle to getting that done is we have to be able to trade to and above 21.14 By the way, there's an exception to this. If we were to gap above 21.14 and hold above, that would be very bullish and then would expose us and set us up for a potential break to the upside. But as long as we open below 21.14 I would expect responsive sellers in or about this area back to the downside, and I would be looking for short location, and I would be looking for short swing signals to get produced up in this area for pushback to the downside, and I'm looking for long swing signals to set up from 2078 to 2069. Those long swings I tend to set up in the room when my indicators and trade location identify them as prime trade areas. So that's kind of the picture, bigger picture, right? Obviously holding the grease low, very, very important. Technically, by the way, it was 2033. If you look at the 24-hour chart, the year-to-date high, breaking above that, very, very important. That occurred at 21.26 it's important that we close above and hold above that. And lastly, remember, we're one timing to the upside. The first clue that we'll have that we are going to that we have any weakness or that there's a change in the general trending up that we've experienced all through last week will be that we will trade below, not necessarily hold below, but trade below 20.95. Right? So anyway, that's my summary for the week. Those are the key areas heading into Monday morning. And remember, a couple of key things that you need to be a successful trader. First of all, a written trade plan. Number two, a journal that you actually track your own behaviors in, and that is an effective tool for identifying what you were thinking and how you were feeling both before you enter a trade, while you're in a trade, and after you're in a trade, right? And then the corrective actions you're going to take for any mistakes that you made or errors in judgment or not following your trade plan, right? And also identifying the areas where you did well. Most importantly for traders, I can't stress this enough, be nice to yourself. Shredding yourself does nothing for you as a trader. You've got to be nice to yourself so you can learn from your trading errors and you can become a better trader when you show up the next day. The goal is to do more of what you're doing well, right? And do less of what you're doing poorly. If you follow that formula, you should find a lot of success. Anyways, my name is Simon. I am the coach at Trading Perform Coaching, and we love to have anyone who'd like to try out our room you're welcome to try it out. No catches, to put a credit card down. We're here to help people learn how to be better traders. My email is tradeandperform@gmail.com. And I went a little bit over what I thought I was going to. I'm still having to learn the definition of the word brief. But I hope everyone has a great week. Everyone makes a lot of money. Remember, no one trade matters. No one day matters unless you make it that way, right? Anyways, everyone have a great night. I hope this was helpful. And I'll see everyone in the room bright and early. Good night, y'all.